Hello and welcome back to the 2025 Pre-Retiree Academy. It's April, and for most people, this means scrambling to get your taxes prepared and filed. You know, filing taxes is reactive, meaning that it's for last year, which has already happened. But today's recording is about tax planning, which is proactive in nature. It's about making decisions today that can create more efficiency and benefit for you in the future when dealing with your taxes. Tax planning is very important and it looks very different from person to person. It is an integral part of financial planning and estate planning alike. Here at MCF, we believe so strongly in this that 3 years ago we merged a CPA practice to strengthen our team for creating the best outcome for our clients. There's a lot of things that you can do, and this video will really just touch on the basics that can be applicable to the majority of the people enrolled in this program. Now, because of some timing issues this year, this video was previously recorded. However, the information is still very applicable and time agnostic. There are 3 slight limit increases that weren't available when we recorded this video, and we will make notations of the 2025 limits when applicable through slides on the screen. And as always, if you have any questions, please feel free to reach out to me or our team here at MCF. I hope you enjoy the video. Hello and welcome back to the Pre-Retiree Academy. In the opening webinar, I discussed much of planning associated with financial planning as a form of risk management and mitigation. And today's recording is another extension of that. In the realm of saving and planning for retirement, many people focus on investments, but these are not entirely within our control. We can't control the stock market and we can't influence the economy and other forces that can impact it. In the longer term, we can make far more progress by focusing on the things that we can control, such as our own expenditures. And taxes are a significant expense for all of us. Between federal and state income taxes, payroll taxes, capital gains taxes, property and sales taxes, taxes usually comprise a significant percentage of our overall cost. Finding ways to cut these liabilities help us improve our bottom line without the pain of cutting back. But here's the problem. Most people don't set aside regular time for tax planning, so they rarely realize the benefits of it. Here to help us understand this a little bit better today is Brittany Manning. Brittany is one of MCF's longest tenured team members. She wears many hats for our firm and just happens to be a CPA and a certified financial planner, and is the director of our wealth management division and is very involved with our tax planning team. And on a personal level, she's one of my most trusted advisors because she's quite brilliant. Brittany, let's start with the basics. What tax considerations should there be for those who are nearing or planning for retirement?
Yeah, so one of the first things we want to do is try to identify our taxable income and non-taxable income. So one of the first pieces of taxable income for everyone is going to be your Social Security benefits. It's really important to keep in mind that some of your Social Security is taxable and some of it may or may not be. And it really depends on the other types of income that you have each year.
So after I stop working and my income is potentially lower, what are some tax planning opportunities that I could take?
Yeah, one of the things to look at once you retire is your overall income, because you can have some opportunities when it comes to long-term capital gains. There are capital gains rate tiers, and when you are under, for a married filing jointly couple, about $63,300 of income, pay 0% long-term capital gains. So if your overall taxable income is below that level, it can be an ideal time over a couple of years to really take advantage of realizing some gains in your taxable accounts. Coupling this with a really high standard deduction that we have right now allows us to take an additional $29,200 off of our income, which is the standard deduction right now. So we can really help control our ultimate taxable income, get some capital gains realized without really paying hardly anything in income tax.
That's great. I know Roth conversions also come into play here in this category, but we're going to touch on that in just a little bit. In addition to that, are there creative ways to reduce taxable income while supporting like a charitable effort?
Charitable giving is such an important piece of a lot of people's expense planning, and a great way to use that once you hit age 70 and a half, is to use qualified charitable distributions, or QCDs, from your IRA accounts. A QCD is a non-taxable distribution where you send money directly from your IRA to an organization, a charitable organization of your choice. Like I said, you have to be at least 70 and a half to use this strategy, but it's really helpful, and you can send up to $100,000 to an organization. For anyone who's reached the age of the required minimum distribution, you can use up to that limit of $105,000 for 2024 of your required minimum distribution as a qualified charitable distribution. This means that income does not come to you as taxable income and goes directly to the charity.
What about donating stock directly, like appreciated stock directly?
Yeah, another option you can do is using highly appreciated stock is a great vehicle, where as long as you've held that for over a year, you typically can take the deduction as a charitable gift for the fair market value of that stock. So you avoid paying those built-in capital gains when you go that route.
Gotcha. So what is a required minimum distribution, and how does the RMD tax penalty work if you don't take it?
A required minimum distribution is the amount the government has told us that has to be withdrawn from our qualified retirement accounts, IRAs, traditional 401ks, those types of accounts, once you reach age 73 and beyond. It's a calculation that's done every year based on the value of the account and your age. The IRS has published tables that help us make that calculation. If for some reason you don't take your required minimum distribution, you can be subject to a penalty of up to 50% of that amount. So it's a huge thing to be aware of, and we want to make sure that everyone stays on top of that year in and year out to make sure that we avoid paying an unnecessary, very large penalty on that.
Yeah, I'd like to add a couple things on that too. In 8 years, because of Secure Act 2.0, that age will escalate to 75 years old. So there will be some people that are watching this that will impact, that their required minimum distribution will switch to 75. And I also like to say that's the age at which the government gets tired of you hoarding your own money and forces you to take it out. So I like to point that out all the time. What are some tax saving moves people can make before the age of 73 where those RMDs come in?
One of the things that you mentioned earlier, Hunter, was the Roth IRAs and Roth conversions. So we can look at converting assets in your traditional IRAs or 401ks over to a Roth IRA.
So you're talking about the Roth conversion. Can you explain that just a little bit more?
Sure. A Roth conversion is when we actually move assets that are inside a traditional IRA, rollover IRA, or traditional 401k into a Roth IRA. What happens when we do that is we will physically take the assets out and pay income tax on that distribution at that time. Once it's deposited into the Roth account, though, it grows income tax free. So the contribution and future earnings are tax free at distribution.
So the idea is that you're going to convert tax deferred dollars to tax free dollars at a lower income tax rate than when you were working. Is that right?
That's correct.
Okay.
Yes.
And so are there times that it might not make sense to do that?
Definitely not a black and white situation for Roth conversions, and it can even depend on person by person and then year by year. So always want to look at where our income tax brackets are projected to be now versus future years. If it's a small difference, say 10% bracket to 12% bracket, may or may not make sense. But if we're in the 10% bracket now and maybe in the 20 or 24% bracket later, definitely something that we want to consider would be doing a Roth conversion now.
Okay. Anything else that on the basic premise of taking advantage that we can do prior to 73?
Always just keeping an eye on where our gains lie. Can we take advantage of low income tax rates, selling those appreciated assets when we have 0% capital gains, and really coupling all of that with our total planning. What are we giving to charity? Which assets to give to charity? Taking a good look at all of the pieces that come into your income taxes can really help you avoid paying an unnecessarily high amount.
Great. So, in relation, what she's talking about there, a lot of advisors, including Brittany, we call that tax loss harvesting, where each year you look at the portfolio from year to year and determine if larger long-term capital gains can be offset against maybe some losses in the same portfolio or household in the same year. So, in other words, you sell for a gain and a loss and wash them, offset that. Lastly, it's always wise to revisit your withdrawal strategy, because withdrawals from tax deferred accounts are neither penalized nor required between the ages of 59 and a half and 73. So you have more flexibility and control with the withdrawals for retirement savings. So planning by nature occurs in advance to prior something actually happening. I think we all know that. But tax planning is a continuation of income planning, which is derived from savings. Savings is a result from budgeting, and all that comes from your desired income needs and goals that you're going to be looking at for retirement. Understanding all your sources of income and planning for that income in the most efficient way is what really this is all about in order to limit your taxable exposure. Brittany, thanks so much for pitching in and helping and taking the time with us today and giving us a lot of things to consider. Stay tuned the next couple of weeks. We're going to cover the importance to continue to save as you approach retirement, as well as usually the most popular module, estate planning webinar. We'll bring in an external attorney and go over a lot of examples and what you should have and not. Until next time, thanks for watching, and we'll see you soon.